Good morning, everyone. Ladies and gentlemen, it is my pleasure to welcome you today on behalf of UBS and Credit Suisse to the presentation of this 14th edition of the Global Wealth Report. My name is Nanette Heischler-Feder, and I'm joined today by Professor Tony Shorrocks, who is one of the authors of this report, as well as Paul Donovan from the CIO office of UBS. Together, what we'll do is to go through a few prepared comments by Professor Shorrocks and myself around the key findings of the study, after which we will have a Q&A session, hopefully with some compliments that the various authors and different representatives on this call will be able to share with you. In the meantime, I'd like to pass on the word to Paul Donovan for a few words of introduction before we set in on the next course of this presentation. Paul, over to you.
Thank you very much, Nanette, and hello, everybody. This is the 14th Global Wealth Report, but of course it's the first where we're combining UBS and Credit Suisse. And I think our integration allows us to pool expertise and offer unparalleled insights. We represent the world's largest truly global wealth manager, and that gives us access to the ideas and thinking of the major investors in the world, and of course, the experiences of the major entrepreneurs of the world. Now, we're at the start of a truly astounding period of structural change in the global economy. The fourth industrial revolution is arguably the biggest structural upheaval that we've gone through in 250 years. At the same time, economic needs have been evolving, and the rather crude output economics is gradually morphing into a more sophisticated impact economy model where considerations of sustainability and equity are taken alongside pure material wealth. Now, private wealth is going to be absolutely central to this period of transformation. We at UBS have long held that the UN Sustainable Development Goals require a blend of regulation, public investment, and private capital. And that comes from both an investment and a philanthropic point of view. And of course, in all of this, private wealth is absolutely critical. So to mobilize private wealth most effectively in the era of the impact economy, we need to know where the wealth is, how it's being created, how it's changing. And that's what makes this particular report so absolutely valuable in understanding how the global economy is going to develop. Nanette, back to you.
Thank you very much, Paul, for these introductory comments. For those of you who follow this presentation of the report for the first time, let me share a few words of just introduction to the exercise, to this really very interesting study. So it's the 14th edition of an annual, very comprehensive review that we have been making now for the last 14 years. And the Global Wealth Report is really basing on data collected over around 5.4 billion adults around the world, spanning about 200 countries, 200 markets. And what is really very valuable in this particular report is that we don't really only focus on one segment of wealth. We really look at every segment of wealth, whether it is the top of the wealth pyramid, but importantly as well, what is happening at the bottom of the pyramid, and as well for middle wealth segments as well. So it's a very comprehensive study that we are presenting here. What I think is also really quite interesting is that we do include the concept of net wealth, which means that we take account of the fact that individuals have wealth, but may also have debt. And so really interestingly, what is net wealth is what we are interested in. Finally, I would just say also from a methodological point of view that we include assets in wealth that are typically part of pension assets. That seems to be an important one because it helps explain some of the differences in composition of wealth across the various countries. I have to say also that this is one of the most popular reports over the years, certainly for as long as we have done it out of Credit Suisse, the Credit Suisse Research Institute. Just to share a few examples here, 100,000 readers online, 250 media headlines in the past when we would be presenting it, and more than 3 million impressions on social media. Let me now come to some of the key findings onto the next slide in this report this year. I think there are really a couple of key messages to share with you, and Professor Shorrocks is going to go into all the details of it. But the first important message is that for the first time since 2008, in 2022, so last year, we recorded a fall in net global household wealth. So it is worth noting that after a long period of annual increases of household wealth, 2022 marks the first year since long when we saw a small, but still, decline of private wealth. Just to put it in numbers, it would represent about 11.3 trillion US dollars over all the markets that we are covering here. That in percentage points is representing 2.4% decline. And as a result, we are estimating that global household wealth is standing at the end of 2022 at around 454 trillion US dollars. I have to say that when translating that on a per adult basis, this will inevitably mean that also on a per adult base, private wealth has declined for the first time in 2022. It now is reaching an average of $84,718 per adult, and it represents about a 3.6% decline. I should say that a lot of these declines are actually associated to exchange rate movements because we record this wealth estimations in dollar terms. So things do not look quite as bleak if we were to take a constant exchange rate versus the year before. And in fact, by doing so, we would have registered a very slow increase of wealth at constant exchange rates, but of course exchange rates fluctuate, and therefore it is just noteworthy to see that in dollar terms, global private wealth has declined for the first time. The second key message I would say is that at the same time as we registered this decline, we are having a bit of good news, however, and that is relating to how wealth is distributed. In fact, inequalities in 2022 in wealth distribution have declined, and that is at least a bit of a positive message as well to bring over in this year's report. A third message in terms of regional differences as far as wealth developments over 2022 are concerned, I would say that it's noteworthy that North America, Europe have been registering the biggest declines in household wealth, but Latin America has, in contrast, registered an increase of wealth. So in terms of regional distributions, a few differences here, largely due to what exchange rates have done, but also financial assets and non-financial assets have done in the various countries. Regions and countries with the biggest gains have been a number of countries of BRICS. These include Brazil, India, Russia, and also Mexico outside, but as part of Latin America. And countries with the biggest losses of private wealth include the US, Japan, China, Canada, and Australia. There are a few constants as well. And one of that constants relates to how the ranking of household wealth is set up. Switzerland ranking practically year over year as the top country in terms of average wealth per adult, and this has not changed in 2022. Switzerland is followed by Hong Kong, Australia, and Denmark at this top of the wealth pyramid. So these are some of the key findings that I wanted to give you as just a wrap up of the report in its 14th edition. I'm now passing on the word to Tony Shorrocks for all the details of it before taking back the word for some country experiences. Over to you, Tony.
Okay, thank you very much. If we can have the next slide up, please, and we can start. Yes. I wanted to take a step back and just think about the underlying factors, because I think it helps us to better understand the various results, patterns that have emerged last year. In the long run, household wealth is very much related to the level of economic activity measured by GDP, or perhaps even better, something like national income or household consumption. In this longer run, wealth actually increases at a slightly higher rate than GDP or national income. And part of that reason is because there's developments over time in financial improvements in the way that what is offered, financial opportunities, credit opportunities, which allow wealth to increase at a slightly faster rate. And the other important thing is the property rights framework. This is particularly the case for developing countries, where things like land and building ownership rights are better established, and that helps improve household wealth in this longer run. In the short run, there are a lot of reasons why we get variations from this long run trends. These are all really related to price changes. Asset prices in particular, equity prices, house prices are very good proxies for what happens to financial wealth and non-financial wealth. We also have, as Nanette just said, exchange rates. We all know these vary year on year quite extensively, and that affects the way that we value and compare wealth between countries, where we use the US dollar to compare them. There's also inflation, which of course in recent years has become rather more important, and we'll say a little bit about this today. And underlying that really are interest rates. So there's a sense in which these are all feeding together. Inflation changes interest rates, which feed into asset prices and exchange rates. So these are the various factors we need to think about. If we could have the next slide. Thank you. Let me just remind you actually what happened last year in terms of these different price effects. We know that asset prices and exchange rates have varied quite a lot since the start of the pandemic. Last year, we saw a fallback in equities, although the previous year they'd risen quite markedly. So last year in 2021, they'd gone up. In 2022, the losses averaged 10%, but they were much higher. Losses in China, Germany, USA around about 20%, and even greater than that in a number of countries, including Poland, Hungary, Netherlands, Taiwan, Korea, and Sweden. House prices went in a different direction. They tailed off later in the year, but for most of the year, they were quite buoyant, still reflecting the lower interest rates that were prominent. So that house prices in the US increased last year by 7%, 8% in Japan, 11% in UK. Other countries, China, Canada, Germany had more or less had quite small declines, and there were quite big losses in some other countries, including New Zealand, Hong Kong, minus 14% is what they recorded. And then there were exchange rates, and these were quite important last year. The Eurozone was down 5.8%, and China, India, UK, Japan all down by 10% on average. So the big swings in exchange rates. Some countries appreciated, Russia, Mexico, Brazil, and we'll see the implications of that. But overall, it was the US dollar appreciated against other countries, and that depressed the total worldwide household wealth level because it means that they were valued at lower amounts in US dollar terms. Our estimate is that global wealth would have been 5.8% higher if we'd used 2021 exchange rates rather than the 2022 that we saw at the end of the year. Now, if we can look at this, we can see the implications now for what happened, and the crucial or the driving force here is seen in the change in financial assets. You'll see there that in worldwide terms, the financial assets went down. This is partly, this is mostly what reflection of equity prices, but also the exchange rates were feeding into that. Globally, financial assets in US dollar terms, nominal, I should add at this point as well, went down by $19 trillion. This was, and indeed, if we look and see the countries that were really heavily affected, it is North America, Europe, and Asia Pacific, where we, for the purposes of the discussion, we exclude or treat China and India separately. So this is Asia Pacific countries excluding China and India. They also suffered losses nearly $3 trillion. So this is the dominant effect here, a reduction in financial assets, particularly concentrated in North America, Europe, and Asia Pacific countries. Non-financial assets on the whole went up. As I just explained, housing sectors were quite buoyant in these countries until the second half of the year, so that we have this offsetting increase in non-financial assets, which went up 7.9%, $7.9 trillion, according to our estimates. So that is a little under half of the reduction in financial assets was offset by this change in financial assets. The final part is the debts, which on the whole we think had very little change over the period. So when we put these together, we find that total wealth went down because of the increase. The reduction in financial assets was higher than the increase in non-financial assets. That globally, we think that total wealth reduced by $11.3 trillion, or 2.4%. And the regions which were most affected, again, North America, Europe, and Asia Pacific countries. There's two qualifications to that, though. First of all, we are talking about, say, US dollars, and that has depressed these figures. If we look to say what would have happened if we had used exchange rates from 2021 rather than the 2022 exchange rates, then overall total wealth would actually have grown by 3.5%. There was a 5.8% swing, as I mentioned before. But on top of that, if we now go from nominal to US dollars in what we refer to as smoothed exchange rates, which are roughly speaking fixed exchange rates, that would have meant global wealth would have gone up. But again, this is in nominal terms. So if we also take into account of inflation, which was particularly high last year, then that would have reduced wealth by, as we go from nominal to real terms, by 6%. So the two effects, changing to fixed exchange rates and going from nominal to real values, roughly cancel it out, and we end up with again a decline of 2.6% when we take both of those things into consideration. Can we have the next slide, please? Yeah. If we now look and see what these trends are over time, the picture becomes rather clear as to how last year compares with previous experience this century. These are with our smoothed exchange rates, roughly speaking, fixed exchange rates. You will see that last year the wealth did go up a little bit when we use fixed exchange rates, but it is the lowest this century, except for the 2008, the year of the financial crisis. It's also if we look at a little bit at the composition, you'll see that it's the only year since the beginning of the century where financial assets went down in aggregate terms as well. So there's two rather important features. It was a low growth rate compared with previous experience, and it's also a year in which financial assets declined in value. However, it still doesn't look too disastrous compared with previous years. There's other years, there's another 3 years in which we have similar sorts of wealth growth records. Could I have the next slide, please? However, when you take into account inflation, of course, inflation last year was considerably higher than we have experienced this century. And so that makes a big difference. And now when we take inflation into account and look at the growth in real wealth measured again at fixed exchange rates, we find out that we have lost last year, the only year apart from 2008 in which wealth declined. So it was a particularly bad year. It is reflecting these price effects, and really this combination of equity losses and exchange rates effects have made this the worst year since 2008, and even not so different really from 2008 if you look at that graph. Okay, can we move on to the next one, please? Of course, as I mentioned, when we look at the impact on individual countries, then it's really a question of how these different underlying trends have affected individual countries. The United States, of course, wealth per adult fell by some $27,700 per adult. This is, of course, just the impact of equity price reductions. There's no exchange rates effect for the United States, and house prices went up. These other countries which had bigger falls, typically like Denmark, Netherlands, and Canada, and then particularly big falls in Australia, New Zealand, Sweden. These are countries where typically we had equity losses and also exchange rate effects or house price losses, at least one other factor which was combining with those two. There are a few countries which buck the trend, including their Singapore, Norway. I think they were just sort of lucky in a way that they just avoided some of these various underlying effects. I should mention that if we go back a year earlier, you'll see that we reported huge gains in wealth per adult for a number of countries, and very often the same countries. So if we look at the countries here which have lost wealth in 2022, you'll find that a lot of those gained even more in 2021. So over the 2-year period, they're still reporting a net gain. Next slide, if we could, please. As it happens, almost all of the countries were experiencing losses, and so the ranking of countries, if we look at them in terms of which countries have the highest mean wealth per adult, it hasn't changed that much. I should mention here that we do not, there are other countries which quite likely would appear high up in these rankings that we do not report them, simply because they are small countries which are rich, but we just don't have a lot of details, and we don't have a great confidence in the particular numbers. So we're focusing here on the rankings amongst perhaps the top 60 countries in terms of their total wealth. So as in previous years, or certainly in recent years, Switzerland is the top countries, followed by United States and Hong Kong. All of these have wealth per adult above $500,000. When we look at median wealth, which in some ways is a different ranking, and it tends to favor the countries which have lower inequality levels, we get a different ranking, and it's sometimes quite surprising how different the ranking is. And you'll also see here, median wealth is typically less than half of mean wealth. So there's a big reduction as we move from mean wealth to median wealth, and the ranking changes. In all the previous reports, Australia has been the lead country when in the median wealth rankings, but that's changed this year very slightly here. Belgium has edged ahead, and it is partly because wealth went down in Australia by more than it did in Belgium. That's the reason here. And also we find that Hong Kong has overtaken New Zealand in 3rd place, again, because of their reduction in median wealth was less than it was in New Zealand. What is another sort of interesting point here that might not be noticed is to do with the United States median wealth. Typically, countries where the mean wealth goes down, the median wealth also goes down. But you'll see that in this year, or in 2022, United States suffered had mean wealth reduced, but median wealth went up. And the reason for that is that the median wealth holder in the United States is just not someone that has the average portfolio of the country. They have a different portfolio, and on the whole, they hold less financial assets and more non-financial assets. So this increase in median wealth in 2022 reflects the fact that in the United States, financial wealth went down, but non-financial wealth went up, and this has benefited those around the median wealth level in the United States. Could we also move on, please? Next slide, thank you. In the past couple of years, we've given a little bit more attention to median wealth. There's a number of reasons for this. One is we feel that on the whole, it might be a better indicator of the average experience in different countries. The other reason is that we're uniquely qualified to comment on the median wealth. We're the only source really of median wealth in any number of countries from the global perspective. So we're in this unique position of being able to compare median wealth across countries. And the other reason why we're giving it some attention is there's some rather interesting results and insights that come from this. And one of them is apparent in this chart, which shows the trends since 2000, the year 2000, in national income, wealth per adult, and median wealth. And the median wealth graph is the top one. We've got two there. One is just to do it in terms of current exchange rates, and one is in terms of smoothed exchange rates, but these are not hugely different. The big difference is that median, whereas, for example, national income has roughly doubled over the last 20 years globally. Wealth has nearly tripled, but median wealth has gone up by a factor of 6, and there's a huge difference here. How it's possible that median wealth can go up by a factor of 6 when national income is just going up is just doubling? The reason is that when we talk about median wealth in global terms, we're trying to focus on who is the median wealth holder viewed from a global perspective. And on the whole, as you see in other parts of the report, we report on the fact that around the median wealth level across countries, it was certainly at the beginning of the century dominated by China. So when we're talking about the median wealth holder, we're talking about people that are typically in these fast-growing countries where household wealth is going up very fast and much faster than other countries and much faster than global income. So this is essentially it. Of course, over time, the people in China who are around the median have moved up in the distribution. They've moved up into the higher parts of the distribution, but they've been replaced by other people, typically in these emerging economies, which have also been growing quite fast. So this has happened in the past, and we see no particular reason why this would not continue in the future. Could I have the next slide, please? This faster growth in emerging economies is also the reason why we see a reduction in inequality over the past 20 years. We're using 3 indicators here. We have the share of the top 10% is the red line, the share of the top 5% is the gray line, the top 1% is the black line, and the Gini coefficient, which is a standard measure of inequality, is the one at the very top in the darker red line. All of these tend to have reduced over time, and this is because there are 2 factors which are driving global inequality. There is inequality within countries, and on the whole, there's a mixed pattern there. Some countries have wealth inequalities reduced over the past 20 years, but in other countries, wealth inequality has gone up. In particular, in the USA is one of the countries, but the main countries where you really do see inequality going up are transition countries like China and Russia in particular, where they have the private sector, important private wealth that has expanded at a very fast rate. And these are countries where wealth inequality has increased quite markedly. But against that, we've had what we call between country factors. These are the fact that emerging markets, which tended to start off at lower wealth levels, have done particularly well. So the gap with the rich nations has reduced. And this has been a big equalizing factor when we look at it in global terms. You can see here that the clearest example is really with the share of the top 10%, the red line, which has fallen every year from the year 2000, at least up to 2019. It fell from 88.8% to nearly 90% in the year 2000, down to 81% in the year 2019. This was the start, of course, of the pandemic era. Then the inequality, the share of the top 10% then went up, but it's since in the last 2 years returned to the level it was in 2019. So there's a clear reduction pretty well year on year in the share of the top 10%. The other shares tend to be a similar sort of trend downwards, less obvious in the top 1%, which declined at least until the financial crisis, but has since been fairly constant. It's leveled off after 2008, and it varies year on year, but not really trending up or downwards since then. When we look at the changes in the top 1%, and when we look at the recent changes, these are reflecting portfolio aspects that I mentioned before with respect to the United States. If share prices go up, these tends to benefit the people at the very top of the distribution, and that means that inequality tends to go up, certainly when you measure it in terms of the shares of the top wealth groups. However, houses wealth tends to be more prominent amongst the middle groups of the distribution. And so when house prices go up, that tends to increase the share of the middle groups, and therefore reduces the relative share of the top groups. So on the whole, house prices tend to reduce, increases in house prices tend to reduce inequality, at least measured in terms of these top wealth shares. The Gini coefficient is a little bit more ambiguous when you in terms of the inequality effect of house price changes. Can we have the next slide, please? This link, this change is really what it just explains what's happened in the last 3 years, when there's been quite big changes in house prices and share prices. So you can trace the inequality effects, and this year inequality went down, and that is simply because equity prices tended to go down, house prices going up. They're reinforcing each other. That leads to an unambiguous reduction in inequality. And this the chart here is just looking over time at how the inequality, as measured by the share of the top 1%, the change year on year, and how that compares with the change in the ratio of financial assets to total gross assets, financial assets plus non-financial assets. So as the share of financial assets goes up, the share of the top 1% in inequality terms tends to go up also, and when it goes down, the reverse is true. And there's a very, very close correlation there, as you can see from that graph. Of course, it has some implications for the future, which are quite interesting. When we're trying to predict into the future, we're asking ourselves, what trends do we expect in wealth inequality? then it's going to be heavily dependent on what is happening to financial and non-financial wealth. If you think that financial assets are going to grow faster than non-financial assets, then you could expect inequality to go up. If you think, at least in terms of, say, the share of the top 1%, if you think the opposite is true, you expect them to go down. So we don't really know what's happening. It's also, if we're trying to predict the future and ask, is this reduction in global wealth inequality that I just referred to, is that going to continue? It rather depends on, I think, to some extent, on what's happening with China, because growth in China has been such a big factor in driving reductions in global inequality in the past. But of course, China now is becoming certainly is not a poor country anymore in terms of wealth, and it is arguably going to move into the richer group. And so growth of wealth in China in the future is certainly not going to be equalizing in global terms as much as it has been in the past, and it could even be disequalizing. Growth of wealth in China could end up actually leading to an increase in global inequality rather than a reduced level. Can we move on, please, for the next? I need to talk a little bit about what's happening to the top wealth groups. The slide here refers to the ultra high net worth group. That's the ones with adults with more than $50 million. If we just move back and look at millionaires first, we'll find that last year, this reduction in average wealth, and this also combined with this reduction in inequality, has meant that the number of millionaires worldwide has dropped to 59.4 million, according to our estimates, means a drop of 3.5 million last year. About half of these were in the United States, but there was also quite big drops, more than 250,000 in Japan, United Kingdom, Australia, Canada, and Germany. Again, these millionaire number drops, if we look back the previous year, we'd find these are exactly the countries which reported big gains in millionaire numbers. So there are swings year on year. And to a large extent, these are just reversing what happened the previous year. Of course, even with this drop, what has happened is millionaire numbers have gone up by a factor of 4 compared with the year 2000. There are now 4 times as many dollar millionaires in the world compared with the year 2000. One reason, of course, why we've had is that we've had strong wealth growth in these in lots of countries. There's also been a rise in the number of adults, but it also reflects that the fact that we've kept the benchmark the same. $1 million in 2022 is not the same standard as it was back in the year 2000. Inflation helps the number of global millionaires to grow because it reduces it depresses the level that they have to achieve. So for this year, we actually looked at this question and asked ourselves, what difference does it make if we kept the millionaire threshold the same by increasing it alongside with price level? So last year, roughly 6% globally inflation rate in terms of US dollar. So if we had increased the threshold from $1 million to $1,060,000, as we would do if we were keeping it in real terms, we can ask ourselves, what difference would that have made? There would have been a lot more people that would have lost their millionaire status. We call these inflation millionaires. There's a table in the report which gives you details of the total and how that's split between countries. You could almost think of these as being fake millionaires, if you like. These are people that are only millionaires now because we haven't adjusted the millionaire level threshold to take account of inflation. So we think that there were 4.4 inflation or fake millionaires in the year 2022, roughly equally split between North America, Europe, and Asia Pacific countries, this time including China and India. Millionaire totals are heavily dominated by the United States, but if you look at the slide ahead of you now, when we go to the ultra high net worth group, it is even more dominated by the United States. They account for 51% of the world total. Last year, along with millionaires, there was a reduction in this group. We think the numbers dropped by 22,500, according to our estimates, of which 81%, some 18,000 of them were United States citizens. Of course, this again doesn't take into account of inflation. If we added inflation onto that, there would have been a much bigger drop in this, the numbers of the ultra high net worth group. So that is again reflecting this reduction in inequality, a big fall in the number of ultra high net worth individuals. Can we please move on? I'm going to pass now into every year we try to project our numbers forward 5 years into the future. This is, of course, next slide, thank you. It's never easy. It's not so difficult to extend the underlying trends that I mentioned right at the beginning. So there's this underlying growth, but when we come to try to predict exchange rates, that's going to be difficult in the future. And when we come to try to predict share prices and house prices, that's almost impossible. However, we've just had a little look for the first half of this year, just to see what has been happening to, in particular, equity prices. And it's quite interesting because, of course, the last 3 years, we've seen quite violent swings in equity prices and house prices. And these seem to be continuing. For example, last year, equities dropped 19.9% in the United States. So far this year, up to the end of July, they've increased by 18.9%. So almost all of the reduction last year has been reversed this year. China went down nearly 15% last year. This year it was up 4%. Japan went down 5% last year, up this year by 25%. Eurozone down last year 11%, up this year so far by 15%. So it looks like this year we're going to have more swings, and a lot of the reductions in wealth that we observed last year could well be reversed this year again, and this may continue into the future. So predicting ahead is, I think, extremely difficult. We just try to make it, if you like, an intelligent guess. But given these uncertainties, we have to sort of bear that proviso in mind and just say we're just trying to give some indication of where we think things are heading. Having said that, we are expecting at least nominal USD wealth growth to be in the future at a similar rate to the past, so that wealth per adult global wealth sort of increases by 38% over the next 5 years. What is that? Slightly, so around 6 to 7% a year. What is difficult to estimate is how China is going to do, because it's been so important in the past, driving the wealth growth that we've seen this century, and it's not so clear that that will continue in the future. So there may be a dropping off due to China. And we also really don't know what's happening to inflation. Again, that can be one of the other factors that's going to affect these growth rates in the future. But we are pretty sure that most of this, at least a large factor, is going to be wealth growth in developing emerging market economies. And this middle income growth, middle income countries, middle wealth countries are going to be the main driver. We expect their wealth share to increase from around 25% at the moment to 30% in 5 years' time. Next slide, please. These things also have implications for the distribution over the world. We are expecting the number of adults in this lowest wealth tier to drop below 50% for the first time this century. And the growth of the next segment, which we would broadly think of as being the wealth middle class in the world, we expect that to increase, the numbers to expand by something like 268 million is our estimate, and this would then expand it to 37% of the world. So you'll see there a big convergence between the number of adults in the bottom wealth tier and the next wealth tier as we grow over time. Of course, this is again in nominal wealth terms, US dollars, and if we adjust these groups to have real wealth levels, then that would be there would be some difference there. And finally, if we can get the next slide, please. We are also expanding. We expect billionaires to increase worldwide over the next 5 years, and the number of ultra-high net worth individuals to also increase. We're actually expecting here, if we project our figures forward, assuming no difference in inequality within countries, then we'd expect these numbers to increase by roughly 50%, which is a big gain, but that is because there's a lot of people on the borderline of the millionaire group and of the ultra high net worth group. So there's lots of people, lots of adults who are now getting close to being $50 million and who will be promoted over that level within the next 5 years, according to our estimates. Thank you. I think that's all, and I'm sorry if I've overrun my time, but we're now going to pass you back to Nanette, who's going to talk about individual country experiences.
Yes, mindful of the time, I am just going to go very quickly through some of these individual country experiences. This is one of the very interesting features of the Global Wealth Report, is that it can contrast some of these experiences across different country groups. And because the audience this morning is primarily focused towards Asia and Europe in terms of the media attendance, I'm just going to pick some of these markets in these regions just to show to you the interesting differences and contrasts. And I would also just note for those journalists that have to drop off exactly at the hour that please do not hesitate to address any additional questions that you may have if you cannot follow the country experiences all in full, or any of the other sections that you had follow-up questions on. But on to the next slide, let me focus very briefly on from the experience of the two population giants of Asia, China and India, where one of the long-term experiences that you can see on the very left-hand chart on this slide is how wealth per adult has done over the last 2 decades. And really these long-term factors, drivers of wealth that Tony mentioned at the very beginning, namely the growth rate, also explain how the very fast growing Chinese experience has also translated in average wealth per adult rising by a multiple around 17 times, if you like, in those 2 decades, as opposed to India, where it has basically doubled over the same time. But some of it can also be explained in how actually wealth is being hoarded, how it's being held. And this is what is really illustrated in the middle chart of this slide, namely the composition of wealth in financial versus non-financial assets. Here we're just simply showing the share of financial assets in the 2 countries, and you will note that China tends to have a significantly higher and actually increasing share of financial assets over time, as opposed to India, which has much more emphasis on non-financial assets. So of course, if you do have financial assets over time that is growing much more strongly than non-financial assets around the world, then this helps explain some of the differences in the long term. What is happening to financial and non-financial assets also explains a lot of the experience from one year to the next. And China, as everybody has followed, had a tough time in terms of real estate market last year in 2022, but also financial assets, equities, for example, did not have a particularly glorious time. And so the experience has not been one of continuous growth of wealth per adult in 2022, as opposed to India, where actually non-financial assets make up more, and where there has been resilience in that market. It has meant that India had this year-over-year experience that continued to be a positive one. Then we also show some distributional aspects there. There is just this difference where China has moved very clearly in the middle range of wealth globally, but India still continues to have a high percentage of its population that is at the lower end of the wealth spectrum. Moving on to the next group of Asian countries that is maybe interesting just to highlight is the experience of Japan, Korea, Singapore, and Taiwan. There's some differences here, for example, in how wealth has developed, Singapore being the outlier, the positive outlier, and perhaps Japan here being the one that has actually seen the average wealth per adult since 2010 rather be on a declining trend. You can also see the differences in terms of how much is held in financial assets, typically a high percentage that is held in these countries, with perhaps the exception of Korea here. And then once again, the distributional aspects. These are clearly, when you see such a large part of the population in the middle ranges and even the top ranges of wealth, these are already wealthy countries. Then I want to focus on 2 European groups very, very briefly here onto this slide that is bringing together France and the UK, because they are very similar in terms of the experience of the average wealth per adult here. And however, differences in how this wealth is being distributed, with the UK having very clearly a much higher share of wealth in financial assets. I'm going to end my comments with Switzerland and the next group of countries where we are contrasting on the next slide. That's right, Switzerland with Germany and Austria. You can see here how much Switzerland is ahead in terms of wealth per adult over the whole period. And this has a lot to do with the fact that Switzerland very early on introduced a compulsory occupational pension scheme, which means that every individual has been accumulating wealth in their retirement schemes. This is quite a different retirement setup than has been the case in Germany and Austria for many years. It also explains why the average wealth in Switzerland tends to be held much more in financial assets than in the two other countries. And so is also one of the reasons for the different experiences here and the different levels of wealth per adult. So ladies and gentlemen, this gives you, I think, a good flavor of what we have done this year, of some of the peculiarities, because it has been a year standing out versus the more recent experience in terms of global wealth per adult, how also the distribution of wealth has changed from one year to the next, and also the different country experiences. You will find a wealth of details in there. We have come to the end of this presentation without much time, I'm afraid, to ask for any questions, but certainly some of us are available to stand here for your questions if you want to draw over the hour. But otherwise, please do not hesitate, of course, to reach out to your media relation contacts that you can see on the slide, either on UBS or Credit Suisse side. They will be forwarded to the experts, and we will certainly endeavor to give you all the answers you require. So with that, ladies and gentlemen, and really mindful and grateful for the patience everyone has had, thank you very much for the interest that you have shown to this annual update of the Global Wealth Report. A vast amount of details that I'm sure we will find interesting to read in the report. Please do not hesitate to reach out to us for any follow-up questions. Thank you very much for your interest, and have a good rest of the day. Thank you.